In reference to the Oxford Dictionary, currency is defined as a system of money in general use in a particular country. It involves coins and paper notes being distributed by a government, which are then circulated within a particular economy. In this video, Andrew, Julian and myself will be analysing the Australian dollar, also known as AUD, against the euro, EUR, and the Australian dollar against the Great British Pound, also known as GBP. The figure for AUD GBP closed yesterday at around 0.568, and the AUD against the EUR closed at around 0.6773. When assessing currencies, it is important to evaluate multiple indicators in order to allow us to assess whether a currency will appreciate or depreciate against another. More specifically, we will be analysing the relative interest rates, inflation rates, growth rates, and any government intervention relative to these currencies.
Typically, inflation is more likely to have a negative effect rather than a positive effect on a currency's value and hence its foreign exchange rate. The current inflation rate, as provided by the Reserve Bank of Australia, is 1%, which is below the goal of 2 to 3% set by the government. When compared to the previous years, in 2013-2014, the inflation rate was at its goal of 2 to 3%, but in recent times, it has continually dropped to well below the forecasted goal. As the current rate of inflation is low, it shows consumers aren't spending as much and are reducing the consumption of goods and services. Essentially, prices fall because supply of goods is higher than their demand in the market. Inflation rates make it more attractive for Australians to take out loans in the short term. However, for overseas investors, low inflation rates will keep them from investing funds and will contribute to the decrease in the value of the Australian dollar. As Australia is a major exporter of various commodities such as minerals and agricultural products, a decrease in commodity prices will lessen the value of Australian exports and thus result in a depreciation compared to the euro and the British pound. The European Central Bank's aim is to have inflation rates below but close to 2%. And as the current inflation rate for the euro is 0.2%, it is well below the target. And this indicates that prices are going to be rising at a slower rate desired by the European Central Bank. This low inflation rate proceeds to offer lower interest rates, as the Eurozone has a 0% cash rate, which, when looking at the benefits, stimulates economic growth by encouraging business spending due to the low cost of borrowing funds. When compared to the Reserve Bank of Australia, whose cash rate has been continually lowered in recent times to around 1.5%, it also entices people to borrow funds in the short term. Whilst the zero interest policy may seem favourable, it may be detrimental to the European Central Bank in the future, as they are unable to lower the cash rates any further than 0%, and will have to alter their monetary policy in order to stabilise and stimulate the economy. There is a similar issue with the British pound, in that the Bank of England also targets inflation at 2%, and it is currently sitting well below its target at 0.6%. Much like the other currencies, low inflation rates spur consumer spending and economic growth within the country. However, it does not generally attract foreign investments. The British pound has shown a downward progression in relation to its interest rates and is now at a current level of 0.25%. As the British pound has a lower interest rate than the Australian dollar, it results in an appreciation due to its appeal to investors and also its flexibility and higher opportunity when looking to trade efficiently on the market. However, for the British pound, and Great Britain in general, a stronger economy with a larger population, low inflation rates and low interest rates aren't going to be a defining factor when it comes to the strength of its currency, unlike Australia, where these factors will be a major influence due to its smaller population and weaker economic position.
When analysing the relative growth rates, it is important to note that the exchange rate of an economy is positively affected by an increase in growth. According to the analytics website Trading Economics, the Australian economy has experienced a 0.5% growth on its GDP in the last quarter in 2016. However, it wasn't as significant as forecasted. With Australia being a strong outsourcer of minerals and agriculture such as iron ore and wheat, the economy found overseas investment to lessen to its lowest growth rate since June 2015. When analysing the UK economy, it has experienced a 0.4% growth rate on its GDP, with major contributions coming from an increase in household spending, up 0.9% from the last quarter. In the future, job creation and growth could result in a declining rate as a result of the recent Brexit in June 2016, according to the investment company Woodford Funds. However, this is yet to impact the GBP. Through this analysis, the AUD against the GBP would expect to increase the exchange rate of both economies and form a new equilibrium as a result of an increase in the demand for imports. An increase in the demand means that there is an increased need for entities and individuals to invest in the economy as a potential opportunity to gain benefits on the country's growth by gaining profits on investments. When comparing the AUD against the euro, the European economy has a 0.3% growth on the last quarter in 2016, which was a slower growth in comparison to the start of the year. The second largest economy in the world continued to be driven by household consumption, a 0.2% increase, and government spending, 0.1% increase. Whilst the increase in GDP growth may not have been as significant as the AUD against the GBP, there is still a new equilibrium when analysing the graph, which will result in an increased exchange rate. According to the findings discussed and researched, it is forecasted that the AUD against the GBP and the AUD against the euro would be expected to depreciate slightly within the next 3 to 6 months, but not necessarily by a large percentage. With potential, it could maintain a similar exchange rate between the two investigated. As the European and British economies are large operators on a global scale, the AUD wouldn't be expected to overtake the GBP or the euro within the next 1 to 2 quarters. Despite the UK just recently undergoing the Brexit in June 2016, website Woodford Funds states that the UK's economic prospects shouldn't necessarily have any detrimental impact, despite a potential negative impact on the economic growth. This shouldn't have an overall larger effect on the AUD as it would for the GBP against the euro, but that is a different analysis. Furthermore, more appealing interest rates will result in the GBP maintaining a better rate in comparison to the AUD. When examining the AUD against the euro's low inflation rate has a positive correlation with growth rates for the economy, as it promotes spending by entities and individuals. Despite this being the case, with the euro economy being so substantial in size, it won't be anticipated that the AUD can overtake the euro within the next 3 to 6 months.
In reference to the Reserve Bank of Australia, government intervention is defined as the act of the Reserve Bank intervening in the foreign exchange market to create demand or supply for the Australian dollar, and they do this by buying or selling Australian dollars against another currency. The Reserve Bank of Australia influences the foreign exchange market on nearly a daily basis. However, not all of these transactions are recorded as being actual interventions in the foreign exchange market. This is due to the fact that interventions are defined as transactions that are undertaken with the aim of considerably impacting market conditions. So, with taking this into account, the last time the Australian government intervened, as stated by the Reserve Bank of Australia, was November 2008.